Welcome to EQD Research Global Insights for Tuesday, February 16th. Today, we're going to check in on European volatility, check in on the VSTOXX, look at what copper option pricing might be telling us about inflation, and discuss the steep VIX term structure, and maybe take a look at how to speculate on that. So starting out in Europe, the Euro Stoxx 50 is down 0.05%. VSTOXX is up 28 cents to 2044. The February future is up a dime to 2040. February does expire tomorrow, so those two are right in line with each other as to be expected. March is up at 22.45, up 35 cents. And then April to September, 24.55 to 25.10 range. That range has widened out a bit. More about the near-dated contracts coming in than anything else. The futures prices actually peak out in June at 25.10 and then come down a little bit into the fall. Also, VSTOXX is up 155 to 109.96. VSTOXX can be a good leading indicator for VSTOXX, so something to keep an eye on. Volume is moving to March, so I took a look at March option trades, came across a nice one. Somebody bought 1,000 of the March 23 calls for $2.275, sold 2,000 of the March 36 calls for 82.5 cents, net cost 62.5 cents a spread, profits between 23,625 and 48,375. When the trade was executed, March was at 22.35, and also just by selling the 36 calls, they reduced the break even on that trade by about $1.50 or so. Now, I want to address inflation a little bit. There's been a lot of talk about inflation, and the market that I was taught to watch is copper. The current future is up at 382. First time we're over 380 since October of 2012. Been on a very nice steady uptrend since testing the low 200s at the beginning of the pandemic last year. Now, option on commodity implied volatility can give hints of the mind of the market. One of the things I like to do is compare consistent 30-day 2.5% out of the money put implied volatility versus 2.5% out of the money call implied volatility. Now, since January of 2010, call implied volatility has been higher than put implied volatility in the copper complex 29.5% of the time. This year, that same number is 41.4%. And long-term, the average out of the money put implied volatility is 3.14% higher than call implied volatility. This year, only 0.55%. Now, I did place the copper futures and the call to put ratio on a single chart. Notice that a couple of times there are sell-offs in the copper price that resulted in higher out of the money call implied volatility. People buying calls on weakness, something maybe to keep watching, something to check in on the next time we have a weak day in the price of copper. So checking in on the US markets, the S&P 500, Russell 2000, and NASDAQ 100 are all higher. So are VIX, RVX, and VolQ, their respective volatility indexes, benefiting from the kind of tailwind that we get after a 3-day weekend. We did talk about that last week in a video. VIX is up 175 to 2172. February contracts up 30 cents to 2165. March is up a nickel to 25.95, but at a pretty big premium to spot. And April's at 28.20. May to September in a 28.80 to 29.05 range, with June and July being the highest priced futures contracts. Now, with volume moving to March and we're at a big premium, I wanted to check in on the COT report, and specifically the net speculative positions in VIX futures position. Right now, there are 53% more open short futures versus long positions in accounts that report as speculative money. Notice that on this chart, the higher the figure, the greater the short versus long positions. The March future, as I mentioned, is at a nice premium, but there's really not an abundance of speculative short positions, even though it's at a premium. Maybe it's short-term memory, just with what VIX has done lately as far as spiking up. Now, personally, I am a big fan of selling or getting short VIX futures through buying put options. Now, what I've done is I've pulled the offer prices for the March put options, March VIX put options that that are based off the March futures pricing, but do settle into the VIX index. And I'm showing what the profit or loss would be if you just purchased each of these options and held it to March expiration if VIX doesn't move at all. And notice that anything with a strike price from 24 or higher actually would make a profit with an unchanged VIX between now and March, I believe March 17th. Thanks for joining me for EQD Research Global Insights for February 16th. If you like what you heard and found it useful, please hit the like button below and don't forget to subscribe. We also welcome comments and are open to suggestions on how to make this program more useful and informative.